Perfect. Well, thank you so much for the wonderful intro. I do have to say hi to Angie Hunt. Hi.
Yes.
See you. I just spoke with her earlier today. It's good to see your face. We didn't get to see each other earlier. So yeah, welcome and welcome everyone. Thanks again for having me. Christina, always a pleasure to come back and speak for FIBI. I have this last year was a whole whirlwind. I think I'd ended up doing close to 150 or 160 webinars in 2020 and then in the intro into 2021. So we were able to reach quite a few people, as the pandemic started to set in and as it started to kind of slow down. So I'm going to go ahead and share my screen if that's okay. Let's see if I can get this locked and loaded
All
here.
right. So,
And
okay, good.
we good to go? Yeah.
Yep, go.
Excellent, excellent. This topic is near and dear to my heart. Talking about, we're going to touch on a little bit of what might be on the horizon, some changes in the real estate industry as well. Talk a little bit about the fears around the exchange side of things going away, but we'll kind of put out some fires there and some misinformation as well. But tonight we're going to focus on entity selection, how to utilize it to protect assets separately from personal assets, and potentially even receive some sort of a tax benefit from it if the numbers and if the strategy maps out to that benefit. Like I said, this topic is near and dear to my heart. I'm a small business owner. I'm a real estate investor. My wife is a small business owner. I come from a family of real estate investors. So not only do I practice tax preparation, but I also practice what I preach about investing in things like small business and real estate to really shelter income and build wealth. I always joke around with my clients. I say, hey, listen, if I can save you 10 grand in tax, I just made you 10 grand, right? That's the goal. That's how you should view your tax preparer. If they can save you money, they are in turn making you money. And this is really the greatest way above and beyond everything else to truly retain wealth and pay less overall obligated tax to Uncle Sam and whatever state you are investing in. So let's see if I can go to the next. There we go. So you already see my face. This is me. That's actually an old picture I put on the pandemic pounds. My face is a little bit more round today. But, 16, 17 years working in the industry. I've seen a lot. I'll tell you that. I worked through the last recession, 2007, 8, 9, 10. We saw the 2007 Debt Exclusion Act. We saw the Conformity Act of 2010. We saw the Obamacare bill in 2012. I mean, we've seen a lot over the past, 15, 16 plus years. And there's been a lot of opportunity. A lot of people try to focus on the negative side of certain things. And I'll tell you, out of 2020, I can't tell you how many success stories I've heard. Obviously, I've heard a lot of the negative things that happened. I've lost clients, to COVID. So I know that there is that really dark side of 2020. But coming out of that very dark year for a lot of people, moving into 2021, there will continue to be a number of opportunities that we really need to focus on and really tap into and make sure that we capitalize on. So like I said, 160 some odd seminars and webinars throughout the pandemic. Right now, actually, that number is out of date. I forgot to change it. I totaled it up right before the deadline on Monday. I have clients with about $350 million under management right now. Not only management, but also property flipping, overall. But we see a lot at Robert Hall. Most of our senior preparers are real estate investors. And so they very much practice what they preach. And on average, we're doing about 140 plus educational webinars, trying to get as much information to the general public as possible. Obviously, the new tax bill in 2021, it has not been set in stone. A lot of it's speculation. A lot of it's solely based, the information that you're hearing, it's fear-based. And so people, I find, are making very rash decisions based on speculation. There is not a final tax code for 2021. So please, before you start liquidating assets, adding children to title, doing things that in your gut feel wrong, before you do that, talk with your tax advisor and make sure that there is a plan in place to make sure that that is the right move for you financially. Before I forget, I do want to mention that Robert Hall offers free consultations. I'll remind you about that towards the end. So the first question I always like to kind of, start off with is incorporating right for you, specifically you? It's not like you can just go to your neighbor and say, hey, listen, how did the incorporated entity work out on your tax return, right? Because you get a lot of opinions about incorporating your business, starting LLCs to acquire title. If you're a manager of property, should I start an S-Corp, a C corporation, or a syndication? Should it be a C Corp or LLC? Well, that could be right for someone else, but not so much be right for you. Everyone's tax return, everyone's tax scenario is different. And so you have to treat the advice and treat the approach differently. I can't tell you how many times a client will come into my office and say, or be on Zoom call and they'll say, hey, Tony, I started this entity last year because I was on a webinar. And I said, well, first of all, was the webinar with a tax professional? And they say, oh, probably, I don't know. I'll have to go back and check. And people will start movement on things, but not per the advice of somebody who is licensed to speak about this, right? You would never take legal advice from somebody who actually didn't practice law. Just because somebody went through law school doesn't mean that they're an actual practicing attorney, right? I know a lot of clients, I know a lot of family members actually who went through law school, but didn't end up ever practicing law school. And we call it some people say that, well, that would be a waste of time, but that's just the general fact. You want somebody who actually practices these topics, that, the people who you want, to take advice from and actually implement their advice in your own financial world. So if you've heard that incorporating is right for you, there are a couple of reasons why it would or wouldn't be right for you. I first want to say that incorporating is not right for everyone. So don't leave this webinar thinking that, well, I heard this crazy guy on FIBI Pasadena webinar, that said that I should leave, so I should immediately incorporate my property as an LLC or go out and start an S-Corp. That's not what I'm saying. I'm saying that we need to check off a couple boxes before we send you out into the world to actually start this entity. Number one, do you actually own assets? Do you own a rental property? Do you own primary assets? And how do you own that? Do you have it titled under a trust? Do you have it titled under your name? Do you already have entities set up? And so the goal here is to make sure that the number one benefit of incorporating is in fact being used, which is the benefit of asset protection. And so right out the gate, you're looking for an LLC, a C Corp, or an S Corp to separate your assets from your business assets from your personal assets. Now, sure, there are ways for people to pierce those corporate veils, specifically and especially here in the state of California. If you know the legal side of pursuing a business, you know that by filing a charging order in a court of law in the state of California and proving without a doubt with evidence, proof, backup documents, however you're going to prove it in a court of law, that if you prove that there was illegal activity, malpractice, negligence, or straight up just ignorance on the owner's part, yes, there is the ability to pierce this corporate veil. But it takes time, it takes money. And if you are an attorney or if you know people who are practicing attorneys, they would probably tell you exactly how that could happen here in the state of California. So it's not 100% bulletproof, right? But it does add that added layer of asset protection by separating your businesses from your primary social security number. So instead of your property being owned by your social, it would be owned by its own employer identification number, kind of like assigning it its own human body. And so if somebody in theory, sues your LLC, they're technically not suing you individually. Could they sue you both? Yes. But once again, it takes time, it takes money. And so number one, we got to figure out if you actually own assets. For the investor who is just starting out, if you haven't even purchased your first property, why would you ever start an incorporated entity? It just creates more fees for you to pay to the state of California, more tax filings for you to file at the end of the year. So you end up paying a tax advisor more money to do it. So it's very much a right and a wrong time, or even a timeline for you to follow before you actually jump through that hoop to incorporate your business or quit claim deed to an LLC and have that protected under a limited liability company. Moreover, on the real estate side, you want to also make sure that if you have debt attached to your property, that you make sure that the lender is okay with you transferring title to the LLC. Because remember that the lender loaned you money to buy the property, not this new entity that you just incorporated. Because the EIN number of your entity doesn't have any credit. You were the one that had the credit. You were the one that financed the deal. And so if you all of a sudden transfer title to an entity, the lender, I haven't seen this in 16, 17 years that I've worked in the tax industry, but the lender very much has the opportunity to call the loan due and payable in the next 30 days because they didn't loan your entity the money, they loaned you the money, and you've changed that contractual agreement with them by transferring title. So just be aware that there are many things that need to be put in place before you start to strategize and move assets around from entity to entity or from social security number to entity ID number. So number one, if you check off, yes, I do have personal assets. I want them separated from my business assets or vice versa. Okay. Number two, what is the average net revenue? What is the consistency of your company's income? And more importantly, what kind of revenue are you generating? Is it mostly rental income or is it mostly self-employed income or maybe even a mix? Let's say I own 3 rental properties in Austin, Texas, and let's say I have a self-employed real estate business or maybe even a property management business. What most taxpayers don't understand is that rental income is taxed differently than self-employed income. Self-employed income pays federal tax, state income tax, and self-employment tax. It pays Social Security, Medicare, state of California income tax, and also nasty federal government income tax. And so on the self-employed side, you're going to see that you're paying a lot more tax, whereas on the rental property side of things, you only pay federal and state income tax on your rental income cash flow. And at the end of the day, if it's a property that you haven't owned very long, you're probably going to have enough depreciation, maybe even enough mortgage debt to wipe out that profit. And so you're not really paying any tax on that cash flow as it is. For those of you who have owned properties for 30 plus years, of course, you have significant value. You might have tapped into the equity and had a little bit of debt attached to the property. But for the most part, you're probably going to be cash flowing on that investment. But still, if you are profiting on that property, you're still only having to settle up with Uncle Sam in the state of California. There has never been a time where I've seen a rental property pay Social Security Medicare tax unless somebody had advised you to pay yourself a management fee for managing your own properties, which at that point, why would you have done that? Why would you have paid yourself a salary, all of a sudden getting hit with an additional 15.3% of Social Security Medicare tax if rental income at its very inception didn't have to pay all of those additional taxes? So we want to look to see what kind of revenue streams you have, as well as what your consistency in net revenue is. If your net revenue is a break even after depreciation, mortgage interest, and everything, we know that on paper you don't show profit, but in reality, because of adding back depreciation, because of paying down debt, in reality, you could be cash flowing. So why would you not want to not only have a great insurance policy in place for the property, but also have it protected separately from all of the other personal assets that you own? For a self-employed business, it's a little different. Because you're paying all of these additional types of tax on top of your federal and state tax obligation, we want to make sure that by filing as an incorporated entity, it's going to save you more than it's costing you to file, meaning it's going to save you more tax than what it's costing you in miscellaneous filing fees on a year-to-year basis. So we're going to dive into more minute details in a couple slides here about how that all works and what types of entities might be right for you. But question number three. So question number one was, do you own personal assets, and do you want to separate business and personal assets for asset protection? Number two, what's the consistency of your net revenue? And number three, last but not least, what kind of risk and liability do you have in your industry? Well, in real estate, sure, we have risk and liability, but we have great insurance policies in place to help us and support us. But above and beyond that, we're not really talking so much about that kind of risk and liability. When you talk about incorporating a business, I was thinking maybe like a skydiving instructor business would have a high risk and liability in what they're doing, right? So even though the profit might not be there, even though they might not have personal assets, it might be worth it for this skydiving instructing business to be incorporated just to protect them moving forward. Because let's face it, they're jumping out of planes miles in the sky with people attached to their chests. There's a lot of risk and liability in doing that. So most real estate investors will have some sort of entity structure set up, maybe not right out the gate during their first years of investing, but eventually as they start to build their wealth in real estate, they will absolutely cross the bridge over or come to a point in their career where they're going to need some sort of incorporated entity to protect them. Now, some of you might be thinking, well, Tony, I have a great umbrella insurance policy. Why would I need an entity? Or I have an entity. Why would I need this really expensive policy? Well, understand one thing about the insurance policy versus the entity is that they provide two completely separate benefits. The insurance policy is by far the most important thing for you to have. We have insurance and it's there and in place to pay out a settlement in case an unforeseen event happens. We have health insurance to fix us in case we get sick. We have earthquake insurance here in California, especially here in California, in case the big one hits and our houses fall to the ground, right? We have liability insurance in business to pay out settlements in case we are held liable for something. So we all get why we have insurance, and that has a value at the end of the day. It has a value payout. And it's incredibly important for a number of reasons across all industry platforms. But it doesn't allow you to separate business and personal assets. That's not what an insurance policy does. An entity would allow you to assign an EIN number to your asset and separate it from things that you currently own or presently own under your primary Social Security number. So one allows for asset separation. The other is just kind of a valued support program for you in case something unfortunately happens in some sort of legal lawsuit or debacle or a pandemic, right? Or, if somebody gets sick, you have health insurance. You don't want to rely on the government every time you get sick, right? Because that we see how that works out sometimes. So just understand two completely different benefits. So don't assume that you are fully protected if you have a great insurance policy. As you build your real estate wealth, as you start to really cash flow and have these positive cash flowing businesses, you want the benefit of both. Now, above and beyond that, you also want to protect your assets from probate. So the third conversation to have is, insurance number one, entity number two. Third conversation you want to have is, well, who should own my entity? Should it be me individually, or should it be my living trust, or irrevocable trust, or revocable trust, or land trust, depending on how you want to title things? So there are added layers that you can add into this particular mix where it does give you greater anonymity possibly, and also greater asset protection. There isn't nearly enough time tonight to talk about all of those options, but just to whet your palate a little bit, just understand that there are different benefits that you achieve by having both of these great things set up for your business ventures. Now, talking about the limited liability company really quick, I'm not going to talk about the legal side of things because I'm not an attorney, even though I know the legal side because I've talked to enough attorneys about that. I'm not licensed in the legal field, but I do want to mention that from a tax perspective, an LLC provides you absolutely zero tax benefit. An LLC saves you nothing in income tax. It does only what its name entails. It limits liability. And what LLCs are most popular for are protecting or limiting liability on large depreciable assets. Well, the largest depreciable asset that you and I will ever own in our lifetime is a piece of property, right? It's residential or commercial. Unless you own the next big IT cloud company and you have millions of dollars in computer equipment and IT server equipment, okay, that's another example. But most of us, the largest asset that we'll own is a property. Multi-unit, like I said, residential or a single family or commercial. And so LLCs tend to be the go-to entity structures to limit liability. And remember that when I said LLCs save you nothing in tax, well, what I mean is that LLCs won't save you any federal tax, they won't save you any state tax, and it won't save you any self-employment tax. So I'm not only talking about the income tax side of things, I'm also saying that an LLC from a business perspective is not going to help you save on the self-employed tax side of things either. In fact, here in the state of California, LLCs are some of the highest taxed entities out of all of the entities that you have to choose from, specifically in this state, I mean. LLCs have something called a gross receipts tax here in the state of California. So on the IRS side, there's no tax that you pay for having the LLC. LLCs are flow-through entities, meaning that everything gets reported on your individual return, and then you settle up with IRS, Uncle Sam, on your individual tax filing forms. Whereas the state of California, if you have an LLC, you pay California the income tax portion, but then if your gross revenue, meaning let's say you have 10 properties under one LLC and add up all of the gross rents for all 10 properties, let's say your gross revenue is $1 million. Not only do you pay the minimum filing fee of $800, I call it a parking ticket for parking your business in the state of California. It's $800 right out the gate, whether you made a profit, lost money, or broke even. But then on top of that, as your gross revenue increases to above $1 million, above $5 million, above $10 million, your gross receipts tax jumps from $800 all the way up to possibly $12,000, which is just a filing fee. It's not even a tax that you pay to the state of California. They call it a gross receipts tax, but it's actually just a filing fee for processing your LLC in the state of California. So just be aware that California does have a very unique revenue code, and they do tax entities differently. So LLCs are great for protecting large assets. They have a very high gross receipts tax. And so you're looking to me saying, okay, well, Tony, well, what's the difference between the LLC and maybe some of the other entities that I have to choose from? Are there other entities that could potentially save me tax? Will they provide the same asset protection benefit? Well, understand that when you start an LLC, you're trying to protect a large asset. As a self-employed business owner, let's say you're managing properties or flipping properties, and your property dealer status kicks in if you're doing 3 or 4 property flips per year. Or let's say that you just have a small business selling, things on Amazon or eBay, right? Doesn't matter, as long as it's self-employed revenue, that's what we're kind of focusing in on. If you are a self-employed individual, you might want the LLC for limited liability protection, but you want all of the tax breaks and tax benefits of the 1120 Subchapter S Corporation. So just because you started the LLC doesn't mean you have to stay as the LLC. There's a specific form in the tax industry called a 2553S election form that you can file with the government to convert your LLC or even your C corporation into the wonderful Subchapter S Corporation. Now, every accountant is cut from a different cloth, so to speak, meaning that we all have different opinions about how great and wonderful we are and how we save our clients so much money. And, but at the end of the day, wipe all of the smoke and mirrors off the table. It all comes down to case study. In case study, literally what has been challenged in a court of law, in tax court, what has won and what hasn't. And more times than not, the 1120 S Corporation has proven time and time again to be one of the main entities that self-employed individuals use to significantly reduce the amount of tax they pay on, once again, self-employed revenue. Rental income, not self-employed revenue. Rental income pays federal and state income tax. On self-employed income, you pay federal, state, and self-employment tax, right? That's an additional 15.3% of tax. So you're looking for not only the great asset protection of an LLC, but you also want the tax breaks and tax benefits of an 1120 S corporation. So don't worry, you're still getting the great limited liability company benefit because the LLC is not converting fully to an S-Corp. The LLC is just filing an election to tell the government that instead of filing as an LLC, we are going to be an LLC filing taxes as an 1120 S corporation. Your eyes might be rolling back in the back of your head. Obviously, I would love to spend more time in more detail, going to dive down a rabbit hole here as well. But once again, we offer free consultations. We could dive more into detail about that at a later date. Just understand the 1120 S corporation is a very unique entity. It still gives you great asset protection, but it really is mainly for helping self-employed revenue stream earners, property flippers, property managers, or even, once again, the mom and pop shop selling, widgets online, right? It could be any sort of self-employed revenue. So above and beyond that, how does this S corporation work? Because I could show you all the pictures of buildings and all of the cool little graphics and whatnot, but what does it mean when you break it down into numbers? Let's say that, just hypothetically speaking, let's say that after all of your expenses are taken into account, you have a profit, a self-employed profit of $100,000. So easy number to calculate off of. As a sole proprietor or even a single member LLC, remember LLCs provide no tax benefit. If you stay as a sole proprietor or an LLC, you'll pay federal, state, and self-employment tax on the full $100,000. And you're thinking, well, that sounds crazy. I don't want to do that. So how do I save myself some money? Well, by converting your LLC or even incorporating yourself as a sole proprietor, but filing as an S corporation now, filing articles of incorporation and going through the whole gambit with the state of California to become a formal corporation, now no longer in the IRS's eyes are you considered to be self-employed. So you're not just a sole proprietor working as Tony Watson anymore, working as, Christina Suter. You're not working under your personal social security number anymore, are you? Now that you're incorporated as an S corporation, you are working under the name of a corporation. And because you are the 100% owner of it, if that business is profitable, the government says, okay, you are the owner of the company, and the owner of the company that also works for the company has to be paid via payroll, meaning that you are required to pay yourself a salary, but no more than what is considered to be a reasonable salary out of the corporation. Well, based on case study, a reasonable salary for real estate professionals can be as low as and no lower than 35% of your company's revenue. Average is about 40%. So in this calculation, we're assuming a $40,000 W-2 being paid out of your corporation that had net profit, so net revenue of 100 grand. Now, for some of you, you're thinking, well, okay, if I made 100 grand in profit and I paid myself 40 grand, I don't want to pay tax on 140,000. Why would I do that? Well, no. Let's back up a second. Because whatever you pay yourself as a payroll, you get to write off as a business expense. That's the thing. Just like Robert Hall, when he cuts a check to me, he gets to write that off. He gets to deduct that as a full dollar for dollar expense to offset his profit under Robert Hall and Associates. So you get to do the same thing. 100 grand minus your $40,000 W-2 leaves your company with leftover profit of 60 grand. Now, the reason why this is so unique is because as a sole proprietor, you weren't able to break the 100 grand down any further than you had already done it, right? You're paying the full federal state self-employment tax on the full 100 grand. But here you've allowed yourself to break it down into two numbers, a W-2 and a Form K-1. And the Form K-1 shows your flow through profit. And what you've just achieved in this situation is you've properly avoided, not evaded, because I know that some of you have heard me speak before. There's a big difference between tax evasion and tax avoidance. And what you've done here in this situation is you've properly avoided paying self-employment tax on 60% of your revenue. Because remember, you're no longer self-employed, are you? You're an employee of your own corporation. But what you probably didn't know is that self-employment tax is the same thing as payroll tax. And out of all three of these numbers you see on the screen here, what is the only number that you pay payroll tax on? Well, the W-2 of 40 grand. So on $60,000, now that you're filing as a subchapter S corporation, you have properly avoided paying 15.3% of Social Security and Medicare tax on 60 grand. Whereas if you had stayed as a sole proprietor, you would have paid it on the full 100 grand. Let's break it down even further, just to better understand it from a teaching perspective. I love the chalkboard. I love the breakdown. This is really cool. On the left-hand column, you're seeing sole proprietor, single member LLC, really no tax benefits there. You're figuring on 100 grand profit. I'm just using very average tax rates here, 25%, let's say federal, 9.3% state, 15.3% Social Security, Medicare. That bottom line is what we're going to focus on. Really don't care too much about your federal and your state tax rate at the moment. We just care about that self-employment tax. That self-employment tax is in between your state of California income tax and your federal tax. That's a lot of money, right? So how do we figure out, we know we have an obligation to pay federal and state income tax, but how do we reduce that nasty self-employment tax? Well, as you can see, column over column, just by playing that reasonable salary payout game, payout game from the corporation, paying yourself a 40% salary, you've reduced your self-employment tax by upwards of 15.3% of 60% of your profit, which could average out to be about $9,100. Once again, very rough calculations. These are not exact figures. Don't fall in love with these figures, but just to show you kind of how this all works, right? So filing as an incorporated entity, remember at the very beginning when the crazy tax guy started speaking, I said there were 3 check boxes that we had to mark off, right? 1, do you have personal assets? 2, is the net revenue large enough to warrant the tax savings over what it's costing you? Number 3, what kind of risk and liability you are operating at? Well, this is where question 2 really kicks in. Because at 100 grand, let's say that on the low end, let's say my calculations are completely off. Let's say on the low end, it saves you 8 grand in tax, not even $9,200. Let's say that because of unforeseen circumstances and other deductions and adjustments, let's say it only saves you 8 grand. Well, how much is it going to cost this $100,000 profit corporation to file as a corporation? In the state of California, you got your $800 filing fee. You have to run payroll for your corporation because this is how you save the money. You got to put yourself on payroll. So that's another $700-800. So you're at $1,600. Then you got to pay a crazy guy like me to file the return. That's probably another $800, right? So 1,600 plus 400 plus 800, we're looking at about 2,400. Let's round up, say other miscellaneous fees, puts you at $2,500 in filing fees. Well, let me ask you this: as investors, as ROI professionals, right? Because you're always looking for return on investment. Do you think that it would warrant a $2,500 cost to save 8 grand in taxes? On the low end, we really don't know what all of the other outside factors are. I'm just being very general with these calculations right now. Even at 50 grand in profit, you cut that 100K in half, drop it down to 50,000, it's still saving you roughly about $4,500 in tax. $2,500 cost, annual fees covers everything pretty much to save $4,500 in tax. And that's just not with us. That's when you incorporate with anybody. You could take this information, bring it back to your tax advisor. They're going to tell you pretty much the same exact thing. Now, hopefully they are not selling you on incorporating just to charge you for all of these things. Because once again, the numbers have to make sense. You should not jump the gun and incorporate yourself if it doesn't make sense financially, if it's not going to save you just as much as it costs you. Sometimes question 3, which is the risk and liability question, sometimes that supersedes question 1 and question 2. Like I gave the example of the skydiving instructor. That would supersede question 1 and question 2. But for the most part, you need to check off all 3 of those boxes before you take that next step to incorporate your business. I think I've hammered that calculation in enough for everybody. But then coming out of 2020, we've had a lot of questions about, okay, well, now that I have my corporation, I used to have a self-employed business in my house. I used to write off an in-home office expense, but now that I'm incorporated, how do I operate out of my home? You know, during the pandemic, most people worked from home. I was shut out of my office for like 4 or 5 months straight. I worked from home. I had a little kid who was breaking down the doors during my appointments. It was awesome. And he's cute and everything, but you know, enough is enough sometimes. And I love my son, but you know, sometimes when we're talking numbers and we're crunching these things, it's like, okay, the last thing we need is dad's computer, you know, flying off the desk. But at the end of the day, when you work from home, there are expenses that you incur, expenses that are not your employer's, right? And in most cases, most employers didn't really have a formal refund system or reimbursement system put in place, especially businesses that were losing a lot of revenue. So in this case, you know, when people moved home to work from home, their first question was, okay, 1, am I going to be reimbursed for all of this? And number 2, if I'm not being reimbursed for it, can I write it off? One thing that changed back in 2018 was the ability for employees, W-2 wage earners, to write off their in-home office deduction. Self-employed individuals, business owners, have always been able to write off an in-home office. In fact, most self-employed business owners have been able to write off most things under the sun that pertained directly to their business, operational costs and overhead. But when you were a W-2 wage earner going into the pandemic, W-2 wage earners weren't allowed an in-home office deduction, at least on their federal tax return. California never conformed to that change in 2018. So people still put their in-home office deductions on their return, but it only saved them on the state side. And at the end of the day, remember, in-home office deductions, Angie, you're going to like this one because we talked about this earlier. The in-home office deduction is not a negative deduction. It's meaning it's not going to put your income at a negative. It will only offset profit. So your business, in order to deduct an in-home office, your business actually has to be profitable. If there is no profit under your business, the in-home office deduction, it doesn't even kick in as a write-off. It can only bring you down to a true net zero for your business. So if businesses were running at a loss because of the pandemic, their in-home office didn't really even matter. But the key here out of 2020 was, okay, for the employees, was that going to change? Biden's administration has talked about changing things. They have not introduced any change to the in-home office deduction as of today, at least. Shoot, I could wake up tomorrow morning, there could be a whole new tax code waiting, in my email with, 100 emails. Hey, this dropped at 5 a.m. Did you see this? Well, no, I'm going to be asleep at 5 a.m., guys. I'm not an early morning riser. May 17th passed, the deadline's passed. I'm sleeping until at least 7:30, letting my son wake me up at 7:30, and we're good. But as far as the self-employed individuals are concerned, self-employed individuals write off an in-home office much differently than the W-2 wage earners of the world do. And when you incorporate, the in-home office deduction changes even more. So as a sole proprietor, you filed this highly audited form called an 8829 in-home office deduction form. It ran close to a 70 to 75% chance for audit. Most accountants scared their clients to death and put them in this fear position, in this chair filled with fear and regret for taking these deductions because of this high risk audit form. Well, understand that I will never tell you to not take an in-home office. I'll tell you that, hey, we can take it. We just need to be reasonable with the allocation because it does have a very high risk for audit. It is not a place on your return where you want to overestimate. You want to be pretty exact with the in-home office deduction if you are a sole proprietor. But the 8829 form exists because self-employed individuals are allowed to write off in-home office write-offs. When you incorporate, it's much different. When you incorporate yourself and file as a corporation, you no longer file an 8829 form. You actually file a form Schedule E, which most of you are probably familiar with. A Schedule E is a rental property form. And where does that kink in? Like, how does that work, Tony? Because I don't own a rental property. I have an in-home office. Well, at this point, your corporation now has a contractual agreement with you to pay you rent for using that 15 by 15 room inside of your house. This is all built into the Internal Revenue Code. And so your job, your due diligence on your end, because you can't just make up $150,000 rent figure per year and wipe out your corporation with a rental expense and not pay any corporate tax, right? You have to look within a 5-mile radius of where you live, figure out what it would cost your corporation to rent square footage office space with, once again, within a 5-mile radius, what it would cost you per month to rent actual commercial space, including the nearest bathroom in your house. Right. So this room that I'm in right now is not only a guest bedroom, but it's mostly my office. My wife has the beautiful office in the house. I get the little desk in the corner of the guest bedroom. I'm completely fine with it. She's great at what she does. So, but this is not really a major in-home office for me, but it does the job. But let's say that it's a 15 by 15 room. I get to take that plus the nearest bathroom. And I look within a 5-mile radius of where I live, how much it would cost me to rent this size space for office use, just commercially speaking, right? And that is what I can charge my corporation rent per month and pay myself rent. Now you're probably saying, well, why would I do that? It's just, robbing Peter to pay Paul. I'm going to deduct it here. I'm going to report it over here. But what you're forgetting is that your corporation has a reasonable salary payout, and whatever's left over of that salary ends up paying Social Security, Medicare tax. So if I can take another 20, 30 grand out of my corporation, reducing my corporate profit, paying myself, sure, I have to record it as rent on my personal return, but what am I reducing my corporation down to? I'm reducing it by 30 grand, which means that it's reducing my reasonable salary payout, which means that it's reducing my Social Security tax, it's reducing my Medicare tax, it's reducing my state disability insurance, my unemployment insurance. And then all of a sudden I've got a 30 grand write-off here, 30 grand of rental income. And then the only thing that technically is a write-off on my primary residence is my mortgage interest and my property taxes, right? And property taxes are limited at 10 grand total, which might be repealed under Biden's administration. No final verbiage on that just yet. So technically I'm only allowed 2 write-offs just on my primary residence. But now that I have a home office and a new Schedule E, I get to take an allocated percentage of maybe some HOA dues that I pay. If I live in a homeowners association community, I get to take a portion of my mortgage interest, my property taxes, my homeowner's insurance, portion of my utilities, maybe the desk, the chair, the filing cabinet, the improvements that I've made to my office. I get to deduct that. And all of a sudden my 20, 30 grand in rental income I've reported on my personal return is now washed out. And on top of all of those expenses that I just talked about, I even get to take a portion of my home and take depreciation to offset my rental income. Now, some of you might be thinking, well, Tony, that's crazy. Then when you sell the home, it's going to cause all of these tax implications. I'm going to have to recapture depreciation. Well, if your accountant files your return and you actually end up paying tax on recaptured depreciation because of an in-home office, clearly they don't understand the tax code. Because when you sell your primary residence, one, if you're married, you get a $500,000 tax-free exclusion. If you're single, you get 250 grand. And we're not talking about hundreds and hundreds of thousands of dollars in depreciation recapture. We're talking about very, very minute amounts, but those numbers add up, right? We're not trying to offset $1 million in revenue. We're trying to offset $20,000 to $30,000 in rent. Minus mortgage interest, property taxes, all of those other things, it should be pretty easy to get you down to a bare minimum. But even if there is profit on that Schedule E, what you have to remember is that you've achieved the benefit by not having to pay Social Security and Medicare tax because it is no longer self-employed income. It is rental income. And rental income doesn't ever have to pay Social Security and Medicare tax. This is all built into the current, old, and possibly new Internal Revenue Code. I can't really speak to the future. Wish I had my magic crystal ball to tell you what was going to happen over the next 6 months. I just don't. I can speculate, but what good does that do anybody, right? This has been around for a very long time. It's been a huge tax shelter for a number of self-employed business owners, property managers, property flippers, property dealers. Just a great, great part of the Internal Revenue Code. You just got to know how to use it reasonably, right? Because at the end of the day, the deductions that you take on your return, they have to meet 3 requirements under Internal Revenue Code. They have to be ordinary, necessary, and legitimate. I throw in a 4th requirement above and beyond everything. It has to be reasonable. The amount that you're deducting, it should be reasonable. So always, always remember that. That's the one thing that gets people audited the fastest is when they are overly aggressive and they are not looking for the reasonable push in certain areas of their tax return. And that's also where a good tax preparer comes into play. So the in-home office, great deduction. I truly believe that coming out of 2020, the in-home office form will have a lower risk for audit. But remember, I have no case study on any of this stuff. I have no case study on pandemic audits because they're still auditing 2017 and 2018 returns. They haven't even gotten to 2019 audits yet. The government is about 3.1 million documents behind in processing. And so when you are bugging your accountant about getting something pushed through, understand that we're working. I could call every single day to the IRS. And I can't get somebody to push something through if it is in that queue of 3.1 million documents, especially paper filed amended returns. That's just where we're at today, folks. That's just where we're at. We're entering into this pipeline as we submit things to the government. It is a massive pipeline that is so blocked up that it probably if you could imagine this or fathom this, it's probably thousands of miles long of plugged up pipeline. And that is what the government is dealing with right now. Sure, they'll collect your money and they're going to cash your checks. I promise you that. But as far as processing your paper requests and anything else that requires it to be set in that queue, it's going to take some time. So just be aware of that. 3.1 million documents. It still blows my mind. Every time I talk about that number, it just is, once again, it's not really fathomable to think how many documents that is behind. And the IRS isn't fully even open back up and running. I mean, they're open, but they don't have everybody on deck just yet. I think they're only staffed at about 40 or 50% right now, as opposed to how they were staffed pre-pandemic. So just keep all of that in mind. Now, one thing that I really look forward to not expiring is something called the qualified business income deduction. And this is for all of the rental property owners. This is all for the property managers. This is for the property dealers in the room, the rehabbers, the wholesalers, all of you. When you have qualified business income, which is not W-2 income, it's not Social Security income, it's not retirement income, it's not unemployment income, it's not capital gain, it's not interest, it's not dividend. All of that is really considered to be unearned revenue. We're talking mainly about K-1 income, self-employed 1099 income, and what K-1 income includes the partnership income, S-corporation income, all of those things, or even your Schedule E rental income. This is all qualified business income. Now, starting in 2018, if your income fell below one of these 2 thresholds. So if you're married filing joint, you're going to go to the left. If you're single or head of household, you're going to go to the right. If your taxable income, not your adjusted gross income, but your taxable income, married filing joint, for instance, let's say your taxable income fell below $326,600. Boom, you qualified for the full QBI deduction, which made 20% of your qualified business income tax-free. Now, what did I say? Qualified business income is only really rental cash flow, self-employed Schedule C income, K-1 income that is coming through from a partnership or an S corporation. So it has to be this qualified business income type revenue stream. But let's say that my wife and I both self-employed. Let's say that she made 200 grand in her business. That's after expenses. Let's say I kicked in another 100 grand in profit. So collectively, let's just assume for numbers sake that our taxable income is 300 grand, right? This is after all of our expenses, after our itemized deductions, things like that. So let's say we're at 300 grand. Well, we're below $326,600. So how this works is if we can get ourselves below 326,600 at $300,000, we qualify for QBI and 20% tax-free benefit kicks in. 20% of 300 grand is $60,000. That is $60,000 that we don't pay a single dime of federal income tax on. California is not conformed to this. So you still got to pay the piper here in the state of California, right? You still got to pay all, whatever that tax rate is, highest tax state in the US. So you're going to pay California state income tax. Somebody's got to pay for all the unemployment checks, right? Because there's a lot of money that needs to be paid back in the state of California. Even though they've mentioned that we're at a surplus right now, smoke and mirrors. We're gonna owe a lot of money over the next couple of years. But the focus is on creating more tax shelters for businesses to create more wealth in all of these states. Here in California, I don't know if that's going to be the end result, but we'll see, right? A lot of speculation, a lot of doubt, a lot of concern. But this QBI deduction is on the federal side, not on the state side. So if you can focus in at the tail end of each year that this QBI deduction is available, you can plan ahead to max out deferred comp, to buy corporate assets, to make more improvements to your rental properties, decreasing cash flow, and potentially dropping your married filing joint taxable income below 326. If you're single, below 163, and boom, 20% of your qualified business income now is tax-free. If you are above these thresholds, don't worry, you still qualify for some of it, but you don't qualify for all of it. But the goal is to plan ahead. We've coined this phrase in our office called POP. As cheesy as it is, POP stands for power of planning. I can't stress this enough, that planning ahead to pay less tax is the right of every taxpayer. Judge Learned Hand of the Ninth District Court a long time ago, don't quote me on a year here, but I read an article like second year that I worked in the tax industry, and it really, really stuck with me. Judge Learned Hand of the Ninth District Court stated that it is the right of every tax-paying citizen here in the United States to pay less tax by planning ahead. Meaning that if you implement a strategy to further reduce your taxable income, dropping you into thresholds where you qualify for stimulus checks, qualifying for child tax credits, qualifying for the QBI deduction, that is your right. And the government will actually allow you to deduct all of the money that you've made and reinvested back into your businesses. Most of the improvements, qualified improvement property, perfect example. The way that you can think of this coming out of the CARES Act in 2020 is if I want to improve, what would be a good example here? Qualified improvement property is mainly interior improvements, not exterior. You can't really add 2,000 square foot to a home and consider it to be qualified improvement property. But imagine, some wall patching, some paint, some electrical outlets, things like that. Qualified improvement property can be accelerated at 100% tax write-off coming out of the CARES Act. So we see a lot of people separating exterior kind of structural improvements from qualified improvement property, which can be fully dollar for dollar deducted on the federal return. And so naturally, if you want to make all of these improvements to your rental properties, further reducing your taxable income, dropping yourself below one of these thresholds, you could also be achieving more credits, more stimulus checks, repayments. If you didn't qualify for any last year, you could actually be qualifying for some of these this time. And then on top of that, you are making 20% of your qualified business income tax-free. Now, if your head isn't spinning and you haven't fallen asleep yet, or your eyes haven't rolled back in the back of your head, and you actually understand what we're trying to achieve here, what we're trying to accomplish, good on you. Good for you, because this, to me, is probably the most sexy thing about the tax industry, is the fact that we can plan ahead to keep more of our money. Failing to plan is ultimately planning to fail. I've used that term probably thousands of times now, but put a plan in place to profit, right? To retain wealth. Because in my opinion, once again, I said earlier, if I can save my client 10 grand, or if any of our senior preparers can implement things to save you money, that's like making you more money. But that is also allowing you to retain wealth. And wealth retention in my mind is probably the most important thing, not only for my family, but for legacy. I want my grandchildren's grandchildren to be still eating off of the profit that I've made over my lifetime and built for them, so that they don't have to work nearly as hard as I do. Well, we could all disagree or agree on that, but I want to leave a legacy that makes the future a little bit easier for our next generations, because they're going to have it bad enough. I truly believe that they're going to have a heck of a time in the upcoming years. But naturally, that QBI deduction is available for everyone, but you have to qualify for it based on future planning. We offer a number of services, by the way. Tax planning is one of our biggest. We're not just a place where you drop off your paperwork, you have us file your taxes, and then never talk to us again until next tax season. We're here year round. I mean, we do educational seminars, we do internal auditing, we do payroll services, incorporating services, estate planning, financial planning. We talk about syndications, we educate our clients. I mean, there are a number of services. Obviously, our tax preparation service is the number one service we offer. But if you are in need of not free advice, but if you're in need of a consultation to see if things are being filed correctly on your return, that's where we come into play. 9 years ago, I think it is 9 or 10 years ago now, we really talked to Bob Hall and Janice Hall, standing right there in the middle. Bob Hall is like the tax almanac, been around since 1971, built this firm, 50 years in the business, one of the most philanthropic families I've ever known in my lifetime, one of the hardest working families as well that I've ever met in my lifetime. But Bob Hall, 10 years ago, we really struggled with him because we wanted to tell him how important it was for us to get our knowledge out to the general public, to let them know what their opportunities were from a tax planning perspective. There was a little bit of pushback at first because, he didn't want people to know what he knew. That's what creates value in our industry, is the knowledge that we have. But, a very short conversation we had with him, and 10 years later, we've serviced, gosh, I think close to maybe 4,000 or 5,000 second opinions just in the past, I think 5 or 6 years when we started actually tracking those statistics. This is actually an old picture of our staff. We've got about 55 people on staff with Robert Hall. We service tax filings in all 50 states, but only one location in Glendale, Southern California. So, we're not a fly-by-night firm. We've been around for a very long time. I have some clients in the audience tonight. So like I was mentioning earlier, saying hi to them. And so if you are a new client, or if you're just looking for a review of your tax return, talk with us. You can open up your smartphone device, right, and wave it over this little QR code, and it automatically pops up. Technology, right? It blows my mind. I don't know how it all works. It's all dark magic to me. Like it's like witchery. It's like witchcraft. But you wave your camera over the scanning QR code. It pops up a link. It allows you to sign up for the free consultation, or you text Robert Hall to the number 72,000. The main benefit of these free consultations is to really look at 2 years of your tax returns, figure out if there's any red flags or triggers on that return that we could squash, or moving forward, we mold you into the Robert Hall and Associates client where you're maximizing the benefit, but in different ways. And then obviously we'll let you know about upcoming events, our free educational webinars. And obviously I think that Christina, I think it would be good for me to come back once Biden's tax code is rolled out. Yes. I'll have a whole new webinar series available for people. So I'll be a very, very busy man towards the end of the year. I always say busy for me is gainfully employed. So the more changes the government makes, the more people will need me around. So I'll count that as a blessing.
But you will stay gainfully employed then, because there's no question there's going to be more changes coming ahead.
Very much
so. Does anybody have questions for Tony? I have found Tony very quick on his feet and pretty capable of answering questions, even if they're complex. So don't be shy. If you want to put your questions in the chat box, you're welcome to. Tony, I guess the only thing that I saw that maybe I could ask you a little bit about is the possibility of the 1031 being capped. Can you talk about that for a little bit?
Absolutely. So I did some research as the deadline kind of approached, because I knew that this was going to be kind of the highlight of a lot of webinars. The 1031 exchange industry creates about 570,000 jobs for the U.S. economy, and that's a statistic I pulled off of many different websites, and it's all kind of averaged about 570,000 jobs. It creates $125 billion in taxable revenue for the federal government, and about $25 billion in taxable revenue for labor. Right. So you're looking at a $150 billion industry. I don't think that it's going to go. I know a lot of people feared that 1031 exchange industry is just going to belly up overnight. I don't think that's ever going to happen. I think that there will be phase outs and caps, obviously. And what we're all kind of honing in on is this $400,000 taxable income range, which is where Biden has really focused his time, is that $400,000 threshold. But where the code really starts to change is for single individuals at taxable income of $523,000, for married filing joint $623,000. Now, if you think about this, if Biden really wanted to hit the wealthy, he'd be hitting people probably on everything across the board in those income thresholds. But remember that if you're at $450,000 of taxable income, your tax rate is the same almost all the time. If you're single at 450 grand, your tax rate is the same as Bill Gates. right? How is that? I mean, we're not going to talk about fair politics today. I don't want to open up a can of worms, but how does $450,000 to $500,000 match up tax wise with a person making $100 billion or valued at $100 billion, right? It just doesn't make sense. So I think that the true thresholds won't be around 400,000. I think that will be the honing in point for tax brackets changing. But as far as the exchanges are concerned, there will be caps, and it will probably more likely than not end up being taxable income based. I've heard a couple other speculative articles, or read a couple other speculative articles where they're talking about only taking half of the gain and making it excluded in the exchange. And that sounds good in theory, I guess, but what the government also fails to understand is how many people truly here in the US have all of their retirement locked up in real estate, right? I might not have a single IRA, 401k, pot to you know the phrase, right? I might not have any of those retirement plans in place, but I got all of my equity in my real estate.
Yeah.
And all of a sudden you're going to let an IRA defer the tax until the sun comes up, but you're not going to let me, who spent my whole life managing property, putting roof over people's heads, hiring people to work on my properties, deferring tax. You're not going to let me have the same benefits as an IRA or a 401k. That doesn't seem fair. And it isn't fair, to be real honest with you. It's not fair. But the tax code in most cases, in most positions, if you look at the tax code, it's not fair. And that's what creates a lot of revenue for the federal government. So I think that at the end of the day, I think there will be changes around the exchange industry. It will still continue to be available, but it may all be based on taxable income as well as property portfolio. People don't hear about this a lot, but depending on how many mortgages you have, depending on how many properties you own, I mean, it could be a number of qualifying factors. People get stuck on these one article types of things and thinking that the government's going to have one qualification to see if you're going to be able to qualify for an exchange. There will be probably 15 different check boxes that you're going to have to mark off on a return in order to figure out whether or not you qualify for an exchange. So it's all speculation right now, but as soon as that comes out, I'm going to put together a webinar, bring it right back to you with all of the correct information.
Yes, because I have in the past used 1031, and I have in the past chosen to bust a 1031 intentionally. And obviously a choice about a 1031 is completely based in tax code, and whether that tax code is even available to me as an investor, as a professional investor. So another question that did come in, John, thank you for the question, is what is a disregarded LLC? And anybody else, if you have questions, please put them in the chat box, or at least let me know you have one in the chat box.
Yeah, disregarded LLC is a limited liability company that files not as a separate filing. It files on your individual tax return. From a legal perspective, I can't really dive into the legal side of what the difference is, legally speaking, between a disregarded LLC or disregarded entity, right? Because LLC, it's not a disregarded LLC, it's a disregarded entity that happens to be an LLC filing. And normally that just means it's not going to be a separate tax filing treated as a completely separate entity. It's going to be all filed on your individual tax return. It changes per state, right? Because, I've had a million conversations about California's filing fees, and if we as residents can incorporate elsewhere in the US, and if you use a disregarded entity, you've been told that you don't have to pay California's filing fee. You just have to be really careful. I'm not going to tell you if that's correct or not. I don't want to argue with anybody tonight, because I have gotten into those really strong arguments in the middle of webinars, and I'm not an argumentative person. The code is what it is. If you pick up the phone today and call the state of California, they're going to tell you, I don't care where you incorporate, you owe us $800, because they go off of residency. And if you individually are the sole owner of an LLC, 100% owner, whether you're incorporated in Nevada, in Delaware, in Florida, doesn't matter. California is one of 8 states that taxes its residents on their worldwide income, and they're going to charge you that $800 filing fee. The only time I've ever actually second guessed myself is when somebody said that if you have an LLC out of Delaware with a C corporation that is held in a land trust out of the same state, and that C corporation and land trust are the primary owner of the LLC, yeah, there's really nothing that is attached to you at that point. You might be the managing member of these entities and kind of manage the financial side of things, but nothing really ties back to the state of California. I heard that from Mr. Land Trust himself. Yes. So if he stands by that word, but like I mentioned earlier, I talked to a client today about this. I said, get it in writing. If somebody's going to tell you not to pay your $800 filing fee, you're not going to hear that from me. But if somebody tells you not to pay your $800 filing fee, ask them, put it in writing. You know what they're going to tell you? They're either going to email you verbiage saying, well, I'm not a tax professional, you got to talk to your tax professional. Or they're going to straight up tell you verbally, well, I'm not a tax professional, so don't take my word for it, take your accountant's word for it. And what I'm going to tell you is you got to pay the $800, That's that. At the end of the day, I've worked in the industry 17 years. I've been round and round. I've argued literally till I was almost blue in the face with the state of California. Never been a winning position because we are the highest tax state in the U.S. and we do tax every single revenue stream for California residents the same way. You can move out of state and have investments here in California, and even then, you pay a non-resident tax to the state of California. So they want a piece of that pie. No matter where you live.
Work in California, you live in California, you pay taxes in California.
Yep.
Even sports professionals, I have been told, have to pay taxes in California for the sports games they play here in California because California.
I have soccer players, 36 states. They're 30, well, more than that sometimes, but sometimes the tax rate is so low in the states, it's not required to file. But yeah, W-2s issued in 30, 40 plus states. It's it's crazy. It's crazy.
Kirk, you got a question?
No, I'm just thinking about how insane that is.
Yeah.
So Tony,
I'm aware that California likes their money. So.
Yep. You. Tony, I'll fill the time with one more question because I think people here need to understand this. So I am considered a real estate professional, and anybody that is a real estate agent is also considered a real estate professional. There is a code that guides real estate professional. And why would I want to be a real estate professional, Tony?
Oh man, when you talk about I use the term unicorn a lot because I feel like as a father of a 2-year-old boy, but then my baby girl is on her way 3 weeks from today. So June 12th is her due date, but I'm going to be welcoming a baby girl in our family in a couple of weeks, my wife and I. So unicorns are all around our house right now. But the unicorn of the industry is the real estate professional election. I'll use that example because it is truly the most unique election that you can make as a self-employed individual. And number two, it is a very specific part of the Internal Revenue Code that essentially opens up, in a good way, Pandora's box. I know the Pandora's box is used in a negative way, but in this case, I'm using it in the exact opposite way. It is Pandora's box from a major benefit position. And when you check these boxes on an individual return or even on an entity return to make yourself an active participant in real estate related activities, you not only get to take advantage of grouping rules and grouping elections, you get to take advantage of accelerated depreciation write-offs, and then you also get to allow yourself the full dollar for dollar loss deductions through all of your rental real estate portfolios. And that is where the mecca of the tax code, it culminates essentially. Now, I'm going to go off on a side note really quick if we have a minute, and I'm just going to explain to you kind of the history of all of this. A lot of people hate the wealthy of America because they don't understand how they pay such little tax, right? With all of this money that they're making, how could you possibly make $41 million in a year and pay 15% tax? Well, there are a couple key factors that you need to be aware of. One, they have great accountants, right? And a person making $41 million, as much as you want to argue about how they're crooks, if they know how to utilize the tax code, first of all, I doubt that the wealthy of the world, they literally sit down. I've never imagined like a Mitt Romney or a Bill Clinton sitting at his laptop using TurboTax, right? I mean, it's something that we can laugh about thinking, but that's not how it works, right? They have teams of people like me, probably teams of Robert Hall and Associates accountants filing their foundations, so on and so forth. But the one most consistent investment that the 1% of the world have is real estate. And these real estate professional tax codes, they have changed over the years, but the major real estate deduction benefits have been around since 1962, okay? And a lot of the wealthy of America, they're either still alive and very old or long gone, right? So 1962 is when they started to introduce this, and it's because they know, and the government continues to know this about real estate, is that real estate is the true stimulator of the economy. I don't care how many stimulus checks you send out to the general public. The true stimulator of the United States government or the United States economy is the transactional dealings of real estate on the buy, the sell, the exchange, the acquisition. It doesn't matter. It creates possibly hundreds of jobs per transaction. On the front end, on the back end, you're dealing with lenders, mold inspectors, contractors, courier services, title insurance. I mean, you name it, that's the true stimulator of the US economy. It circulates hundreds of billions, if not trillions of dollars in the US economy each year. So when you talk about the tax code and how the real estate professional status is really unique, it's telling the government that by checking this box, one, you meet 750 hours or more working as an active real estate professional in the industry. And number two, what people don't understand and what isn't written in the code, but is absolutely probably the second question that an agent asks under audit is, where does a majority of your individual income come from? Are you a medical professional making $1 million W-2 through Kaiser, but then just enjoy investing in real estate? Well, that person wouldn't be able to check that box, real estate professional, but his or her spouse might be able to, right? Because the spouse might not be the medical professional, but could step in as the real estate professional. So what you see a lot of people doing is they have these high income earning spouses that make millions and millions of dollars. And then they take that $1 million in the joint relationship, they buy a bunch of real estate, and the spouse goes out, gets their real estate professional license. And all of a sudden, because the spouse is able to check that real estate professional box, after depreciation, mortgage interest, property taxes, insurance improvements, all of that stuff is taken into account. Let's say I have $1 million W-2 here, and all of my real estate portfolio shows, I don't know, let's throw out a number, $200,000 in losses, but mainly because of improvements, depreciation, so on and so forth. By my spouse checking that real estate professional box, we are not limited to the deduction of that loss, meaning my $1 million W-2 is directly offset by $200,000 in losses. And at 37% federal tax rates, now probably going to 39.6, that saves me roughly 40% of 200,000. That's $80,000 in tax savings simply by my spouse electing real estate professional status. It is the unicorn of elections. It is the mecca of elections. It essentially allows or opens the floodgates on all active or passive or non-passive losses. Passive losses against real estate rental investments. And it offsets all income. Well, I take that back. I'm sorry, I spoke too soon. It offsets all ordinary income, but not capital gain.